I'm Sarah Harkness. I'm the MD at IN Accountancy. Most of you, I think, on the call know that I am not an accountant, nor am I a qualified or experienced tax advisor. I am interested, and I do usually make sure that I know what I'm talking about, but caveat it with, let's defer to the specialists here. And I'm not neither qualified nor insured nor licensed to give any advice, whereas Paul, on the other hand, is. So Paul Brown's our tax director here at IN Accountancy. Paul joined us 3 or 4 months ago, with a long history, long career in tax, having started post-uni at HMRC as an HMRC tax inspector. So we won't hold that against him. He has survived and come out the other side. And now he's really passionate about helping small businesses to navigate the complex world of tax and explain the implications of tax legislation really on small business decisions. Yeah. And how to make sure that we stay absolutely firmly on the legal side of what's right and what we can do. My personal feeling, and us as a firm, we're very much, if it smells too good to be true, it probably is. Do not touch it. And if it feels a little bit wrong, just because it may technically be legal now, it doesn't mean it won't be changed. So, do the right thing and understand the consequences, because actually, to a certain extent, we should all want to pay taxes, because that means we're doing well enough to be able to do so.
Totally agree.
But what we do want to do is ensure that you understand the consequences, the tax consequences of any decisions, and you pay as little tax as you should, really. So, without further ado, we are going to get started. We're going to get started with some of the questions that have been sent in advance or asked of us by our clients. We'll do that first of all. And then I can see that Paul's already asked a question, so we'll come to that shortly if we don't answer it, Paul, as we go through. So, starting off then with a question on IHT to Paul. It's IHT and pensions, which I think has been something that has really spooked a lot of people as well. As advisors, we've been telling small business owners for many, many years that put money in your pension. It's a really safe way to separate business wealth and personal wealth, to create wealth for your future, to plan for your future, and to leave something for your children if you don't spend it all, because it falls outside of your estate.
Absolutely.
So, go on, tell me as a broad brush what's happened to IHT and pensions in particular, and also, I suppose, moving on from that, if you could kind of almost give us the numbers. What does that mean in real terms to somebody that maybe has £400,000 or £500,000 in their pension that they've been saving for a very long time?
Sure. So as Sarah says, historically pensions have been completely outside of the individual's estate from an inheritance tax perspective, and they can be passed on IHT free to the beneficiaries of their will. The change that the Chancellor announced on Wednesday last week is essentially effective from April 2027, and what it means is that what they've called inherited pensions will actually be subject to inheritance tax. So what that effectively means is the balance of the pension fund that's there when the individual passes away will be subject to inheritance tax. It's going to be the responsibility of the pension scheme administrator to work out, along with the personal representatives of the individual, what IHT will actually be due on that in the context of the overall estate, and then that will be paid for out of the actual pension fund itself. So, and the rate that's going to apply to that is going to effectively be 40%, to the extent that the total estate is over the inheritance tax nil rate band of 325,000.
But then, so if that pension's passed down, so if, for example, I were to pass my pension down to my children, and say, for ease of numbers, it's a £400,000 pension, and all of it is taxed at 40%. So, how do they get money to pay the tax on that?
So it does come out of the 400,000. It comes out of the fund effectively.
Right,
So it's
okay.
not paid by. It's kind
So they
of
don't have to pay it.
no,
to get it.
exactly. There's not going to be a need for them to draw money out of the fund. The pension scheme administrator will actually sort that out for
Okay.
them. So there will be this requirement, an extra requirement on the pension fund people to effectively speak to the personal reps
Okay.
of the estate and effectively work out, well, okay, what is the IHT that's going to be due on the pension pot as
Okay.
part of that overall calculation.
I'm going to ask you more questions now.
Yeah.
Because, and just for the record, just to be absolutely crystal clear, neither Paul nor I are financial advisors,
No,
pension
100%,
advisors.
yeah.
But I'm going to go on with this one a little bit, because again, if we take that example, so does it then become a pension pot for the people who inherit it, or can they access that cash immediately?
They should be able to access the cash, but the trick is then that they're also potentially going to pay income tax.
So that was going to be my next question.
And,
so they might have paid 40% inheritance tax, and then, normally people who, if a parent dies and somebody is in their 30s, 40s, 50s, at that time where life is really expensive for them, that's whenever they could really do with that inherited money.
Absolutely.
But because it's pension income, that would be taxed as income as well.
It will absolutely be taxed
45%.
Potentially at 45%. So
Wow.
you've got this calculation where if you've got, let's use simple numbers, you've got 100,000 in your pension, you lose 40,000 of that, which means that for inheritance tax, you've then got 60,000 left. You then potentially pay up to 45% income tax on accessing that 60,000. So the effective tax rate could be as high as 67, I think it is, percent on that. What makes it even worse potentially is each individual has their 325,000 inheritance tax nil rate band. And I think we should say if the pension passes to your spouse on death, then it's only on second death that the tax would arise in terms of the inheritance tax. But each individual has their 325,000, and if they pass their main residence down to the next generation on death, then they also get an extra 175,000, which we call the resident nil rate band. So they could have up to, for a married couple on second death, there could be up to £1 million of tax-free, which would potentially cover the pension. But that residence nil rate band starts to erode away once you get over a total estate of £2 million. So if you imagine a situation where at the moment, let's say the total estate between the two is 1.8 million, you'd think, well, I'm going to get my full residence nil rate band here. If you've got £500,000 in your pension fund, that makes your total estate 2.3, which means that you lose something like 150,000 of that residence nil rate band. So depending on the numbers, I think somebody worked out that it could be as high as an effective rate of tax on the pension fund of up to 90%.
Wow.
By the time you've taken into account all of the knock-on impacts, income tax and inheritance tax.
Okay.
So
what about if my children were doing really well for themselves and they thought, I don't need to touch mum's pension, I'm going to hand it down to my children? That'd be taxed again.
Yeah, essentially, yeah, it could be. The balance could still be subject to inheritance tax in their estate at 40%, because that will be something that's an asset of their estate. So
okay, wow. So I suppose what I'm hearing there is spend it. Those tax savings become even more.
Yeah, I mean, I think this is the thing.
Or gifted early.
Well, and I think when we're getting into talking about gifting and stuff like that, there's a really complicated kind of, people get very excited, quite rightly, about inheritance tax, but there's a danger that they actually give everything away and find themselves with nothing left. The problem with drawing down on the pension is, of course, that whilst it's in the pension, it's growing tax-free. So as soon as you draw it down, that growth ends and you're paying income tax potentially on drawing it down after your 25% tax-free amount. So I think there is no one-size-fits-all solution, but I think the old, well, I'll just, pop a load of cash into my pension and leave it to the next generation, that simple bit of planning really needs to be revisited by everybody to understand, what is the best option for them, and how does that interact with the rest of their estate as well. So it just throws the whole estate planning piece up into the air, to be honest.
And I haven't asked you this question, so you may not have the answer at the tip of your fingertips. do we know when this comes into effect, or is it still in consultation for the final detail?
So the D-Day is the 6th of April 2027, but there is an ongoing, what they've called a technical consultation, but essentially there is the opportunity to feed into that. And I have to say, my personal view is that, going back to our favorite expression, the law of unintended consequences, then my hope, and maybe hope rather than expectation, would be that there'll be some tweaking that potentially carves out, say, pension balances up to a certain amount, or effectively quarantines it outside of the estate so it doesn't impact on, say, the residents' nil rate ban, because I'm not convinced that all of this stuff has really been thought out.
Right.
So we have got quite a long lead time. And so the other message is, don't necessarily jump now in haste when it may actually change before it's actually implemented. But obviously we need more detail, really, to be able to understand exactly how this is going to impact.
We'll come back to that one. I think Paul's just asked a question on pensions, if you give me a moment. So,
of course.
Paul's asking, do all pension funds pass through beneficiaries when you die, or do some lapse?
Hello, Mr. Hopwood. Hope you're well. That, I have to say, I don't know.
So my understanding is usually defined benefits do not, often pass, but you'd need to check your pension advisor.
Yeah.
And
I think that's right. There is a distinction between the good old-fashioned defined benefit scheme and the defined contribution, which is obviously the most common now. But the reality is, I don't know the absolute answer to that question.
I think there was an awful lot a few years ago when, and again, I don't know the detail, but certain movements were high, gilts were high, and lots of people wanted to take money out of defined benefits pensions, and were really encouraged not to, because it might have been poor advice or the wrong thing to do. But they wanted to do that because they didn't pass down. So
yeah, and I think that's where speaking to having a good financial advisor is really, really key to understand the implications of those sort of things.
Absolutely. Paul, I'll come back to questions on employer allowances, national insurance contribution, CGT shortly. I'm going to go back to some of the earlier questions and move away from pensions for the moment. So we had a question about the changes for property investors and developers and second homeowners, and when those come into effect. So there have been some changes to both. In fact, we can combine two questions here, perhaps, because stamp duty land tax is one element, and then furnished holiday lets is another, which wasn't really addressed in this budget, but is about to come into effect. Yeah,
that's right. So the big change, I guess, from a stamp duty land tax point of view, is that the surcharge, for want of a better word, that's charged for people who own more than one residential property is going up from 3% to 5%. And that's on the full value of the property. So the way the system works is, essentially, if you own one property, you just pay at normal rates. If you buy a second property, then previously you had a stamp duty surcharge. You paid stamp duty of 3% in addition to the normal rate of stamp duty that you paid. That rate's now going up to 5%, which is, again, quite a significant increase, particularly on, and because it starts from the first pound of consideration, then that will impact everybody. Now, people who are selling their main residence, buying a new property, but they can't quite get the timing right, they would potentially, if they still own two properties, they'd have to pay the 5%, but then they can claim it back provided they sell their former residence within a 3-year period. But for people like property investors who are looking to build up portfolios, this 5% will apply to every additional purchase that they make.
Okay, and this is additional purchases of residential properties?
Correct, residential properties only.
And then does that now encompass furnished holiday lets?
It will, yes, and I think
so that's a change that maybe some people wouldn't have thought.
Yeah, I mean, I think, and just to sort of finish up on the overall 5%, the other body of persons that will be affected by the extra 5% will be companies as well. So if a company buys any residential property, then it will be paying the surcharge. It's not just there is no kind of second home ownership concept for companies. If you buy a residential property in a company, then that 5% will kick in on that. I think that the furnished holiday let change is not something that was part of this budget, but it does start and was confirmed that the government are going to introduce this. It was actually introduced in the April or the spring spring budget. And essentially, furnished holiday lets have had a kind of a little bit of a tax favoured treatment across a number of different areas. I think the ones that people focus on, you're right, are the sort of income or corporation tax treatment and the capital gains treatment for individuals as well. And essentially all of that's being swept away from the 6th of April. So from an income tax or capital or corporation tax point of view, furnished holiday lets were treated almost as if they were trade. They're not quite a trade, but a sort of trade.
Halfway house.
Yeah, exactly.
Grey area there.
Exactly that. So they were kind of quarantined into their own little pocket from a tax point of view. But the big difference from a sort of an income taxes point of view was that you were able to claim capital allowances on any sort of fixtures and fittings and plant, sort of cookers and stuff like that you installed in the property. From 6th of April, that goes to align with what's the sort of more general property businesses. So a residential long-term let might be a good example for that. Again, talking just about resi property here rather than commercial. But essentially, there's a relief now for longer term lets, which will apply to furnished holiday lets, which is what they call replacement asset relief. So it's a rather bizarre one, but if you buy something new and it's the first time it's gone into the property, say a new freezer, it's never had a freezer before. If you buy a freezer, then you can't claim for the initial cost of that first freezer.
But if you had a freezer,
and you replace it, you can.
Yeah.
So that's a real significant change for furnished, for any kind of furnished property, really. That you're not going to be able to claim that sort of tax deduction on that new. So the best example is if you're getting a property and sort of effectively it's or converting it from say commercial to resi or whatever. It's the first time you've installed a freezer or an oven or whatever, you won't be able to get a deduction for that.
So and again, this might be something that you don't know off the top of your head, but where do HMOs fit? So HMOs, houses of multiple occupancy, we've got a lot of sort of full-time and part-time property developer and property investor clients. And I know that a lot of them are going down the HMO route, taking a residential property and converting it into 5 apartments or a house of multiple occupancy. Where do they sit in?
I've got to be honest, Sarah, and say that's not something that I really know the answer to. If it was a hotel or something, then that's something. Clearly a hotel.
I suppose if they're buying it as a residential property and converting it, they're going to have the stamp duty impact.
Correct.
And then we just need to look and find out.
That's not something I've not looked at in a great deal of detail. Yeah, I know. Finally, but I think the other thing about furnished holiday lets, which is really important, particularly for individuals, is up to 6th of April, if you sold a furnished holiday letting business, so then HMRC would allow you to claim business asset disposal relief, the tax relief everybody knows is entrepreneur's relief. You could get that on the sale of the property. So you'd potentially only pay 10% on the first £1 million of gains. Again, it's just going to be a normal residential property disposal after.
So would you also have got business property relief if you handed it down, passed it on?
That's always a little bit of an interesting one, because a business property relief from an inheritance tax perspective, it kind of focuses on the extent to which there's additional services provided over and above the furnished holiday let. So, I think there's been, as ever with tax, there's been multiple tax cases which have turned on, does the owner come in and greet people? Does she give them maps? Does she take them around? He or she take them around, or do they basically just here's the keys? Yeah, exactly. Yeah. So it really what additional services do the owners actually provide over?
Is it a proper business or is it just a
And I don't necessarily think even that will particularly change, but the reality is you've got a pretty tough ask to convince HMRC that you get business property relief on it now, and so it's not going to get any easier into the future.
That probably brings us really nicely into a question that somebody or other asked, which was about the business property relief, because we've got a new £1 million business property relief allowance.
Yes.
So I'm not quite sure what it was before, but tell us a little bit about what that allowance is, what it means, and specifically the question that came is that transferable between spouses or family members in general?
Yeah, and I think this again is a massive change. And I think interestingly, there's been a lot more chat about the changes to agricultural property relief than there has to business property relief, because the farmers clearly seem to be got their lobbying together a bit better, but the changes are the same for both. At the moment, if an asset qualifies for business property relief, which might be, a partnership interest, a sole trade business, or shares in a trading company, then that is effectively its value for inheritance tax purposes reduced to nil. So there's no inheritance tax on passing down businesses that qualify for business property relief.
So this means that this £1 million allowance, does that mean that if the business is valued or the shares are valued at £1 million, then it still passes down at nil?
Absolutely right.
However, it's valued at 2 million.
Yeah. And this is where the nasty kicks in. And again, it was a bit of a throwaway announcement in the budget. And I think a lot of people kind of were a little slow to pick up on this, but you're absolutely right. So if the value of your business interest, if it qualifies for business property relief, it's less than £1 million, then that is still tax-free. So,
and those who have you passed to still get that uplift? Do they get that double?
Yeah, they still get the double bubble of a capital gains tax uplift on the value of the property when they acquire it as well. So, which was something that I thought would be quite an easy thing for them to change, but happily they didn't. But the kicker now comes in: if your business or your farm is worth more than £1 million, then you get your first £1 million IAHT free, but then after that you only get 50% relief against the value. So what we're talking about is you're effectively paying inheritance tax at 20% on the value over the £1 million. I think the important thing to emphasize here is that this is in addition to the nil rate ban. So conceivably, if your only assets are really the business, then although the business property relief might only give you £1 million, there might be some extra that you can get on top of that.
But that would be money that has to be paid immediately. So, excuse me, or during the probate process. So if you passed a business worth £2 million onto your son, he would need to find £200,000 to have that business to be paid cash. And would he have to find that personally? Could he pay it out of the business? Or
I think the first thing to say is that actually, I think the expectation is that there'll actually be a bit like there's some IHT assets where you can apply to pay in installments at the moment. So residential, property, for example, you can apply to pay over 10 years. So I would imagine that the same will apply to this kind of business relief. So it won't necessarily be an immediate thing. But yeah, effectively, that cash will have to be found to pay that IHT liability. And if it's taken out of the business, then there's not going to be any way that you can do that tax-free. So
it would be against the director's loan.
Exactly, director's loan, or you'd have to take it out as a dividend or salary.
So it's personal cost.
So effectively, it's a tax on a tax. Because you're paying tax in order to be able to pay the inheritance tax. Right. But as I say, the expectation at least would be that it will be spread. But in the absence of any other assets, it's hard to see how that can be done without either paying a lot of tax, taking the money out, or even selling the business in order to fund it. And that was the whole point of business relief and agricultural relief, was to stop, the beneficiaries of the estate having to actually sell the business in order to fund the IHT. So, again, this is a massive change.
Okay, so talk to me a little bit more about agricultural relief, because we do have some farming clients on the call actually, and registered to get the recordings. Does that mean agricultural relief, there's another £1 million allowance? So what if I have a farm and I also operate a cafe from my farm building? So I've got a business and a farm. Do I get 2 million?
No, you still only get £1 million, and it's split between the APR and the BPR assets. And I mean, in one sense, you kind of almost, it's the whole concept is a little short-sighted in my view, I have to say. But
I think more farms and farming families are going to get caught by this than the government would lead us to believe, that because of what they put in place, 80% of the spot, it's only the big landowners that are going to be impacted.
It's the classic sort of, if you've got, say, a farm shop, that's a business rather than a farming activity. So you don't get £1 million for that business and £1 million for the agricultural, and you'd effectively just have £1 million to share over those assets. Right. And I think that the other point that we sort of touched on, does that get transferred as a from spouse to spouse on death? So if we look at the nil rate ban that everybody has, then if you're married spouses or civil partners, then on the first death, as long as that's not used up, then that can be transferred to the sort of partner or sort of the married partner.
But if it is used up, it's not in addition to.
Yeah, so but
Okay.
but I think with that, so that's the kind of normal 325k nil rate band. If it's used up, you can't transfer it. So if I gifted 325 grand's worth to my son, for example, on death, and the rest went to my wife, then that 325 that would go to Toby would effectively mean that my 325 is used up, and my wife wouldn't get that as an extra for her in the future. But if I just gave everything to Helen, my wife, then she would get my full 325 plus potentially the residence nil rate band. The kicker with the business relief £1,000,000 is that doesn't look like it's going to transfer. So effectively, if I don't use it, if I had a business worth £1,000,000, I passed it to my wife, she wouldn't get my £1,000,000 allowance for that as well whenever she passes it down.
Right.
So which potentially is really problematic. And I think what it's going to mean is that a lot of people are going to need to do a bit more planning in advance of death, because again, the old thing was, well, I can just die and pass it on and it's fine. People are going to look at ways to kind of use up my £1,000,000 before I pass away, because otherwise it is a use it or lose it kind of thing. So you might look at people that are gifting business assets early to use up their £1,000,000, even popping assets into a trust up to the value of £1,000,000 in order to use that up to make sure that on my death it doesn't get lost. So the whole planning concept is really going to change quite a lot.
So were trusts or family investment companies or anything like that touched upon in the budget in any way?
Only to the extent that family investment companies typically by their nature are not really impacted by business relief, but trusts which have assets which qualify for business relief are potentially going to be affected, because the trust is going to have its own £1,000,000 allowance on business relief. So the old thing was, if you had a business relief asset in the trust, you wouldn't pay, for example, what we call 10-year charges. So for trusts, there's a tax that's an inheritance tax that's payable every 10 years or when assets leave the trust. In the past, business relief assets didn't attract the 10-year charge or the exit charge. Now, again, if the value's in the trust of a business relief asset over £1,000,000, then there will be 10-year charges. The rate effectively is 3%. So you might look at that and say, well, that's not massive amounts, but the reality is that's still 3%, which you've got to find from somewhere within the trust to pay that charge every 10 years. So.
Yeah. Okay. Interesting. Let's move on to something else. So we've got somebody asking that about the impact if they sell their business before or after the end of the tax year. And we've got another question which is not dissimilar. So I'm just going to find that one and add those together, because I think, in fact, there's a few questions all around this selling the business. Somebody else is saying that they're selling the business and they should complete before the end of the tax year, but they've got a 2-year earn out. So how's the capital gains going to be calculated on that?
Right.
We've got another couple, but I'll leave you those two for the moment.
Yeah, no worries. So I think the big changes from a capital gains tax point of view that were announced were the increase in the main rates from 10 and 20 to 18 and 24, and they were effective immediately. So they were, any sale that took place on budget day and afterwards is going to pay the higher rate. So a business sale on that date would effectively have the higher rate. And so in a sense, almost the end of the tax year doesn't impact on that change.
Okay.
The key change that it does impact on is, beg your pardon, business asset disposal relief, which again, everybody, including me, still refers to it as entrepreneurs relief.
Yeah.
But essentially, that's the rule that says if you sell a trading business and you meet the qualifying criteria, then at the moment, if you sell that business, then the first £1,000,000 of any gain that you make up to then, that's a lifetime limit. So if you've had multiple disposals, you only get 1 million hit. That would be taxed at 10%. And then any excess will be taxed at effectively 24% now, as opposed to 20% before the budget. For disposals that happen after 6th of April, then that entrepreneurs relief rate goes up to 14%. And then from 6th of April 2026, that goes up to 18%.
Yeah.
So you can see in much the same way as people were rushing to try and get stuff done before the budget, people are now going to be potentially thinking, well, I'm going to get a sale done. I want to get it away before the 6th of April, because otherwise I'm going to pay up to an extra 40 grand of capital gains tax on the disposal. I think the important point to be aware of here is that although we talk about, the sale completing, it's actually when the contract becomes unconditional is the point that the disposal happens from a capital gains tax point of view. So if the contract becomes unconditional, but it doesn't complete, i.e. effectively the money doesn't change hands for a period after that, then it's the date that the contracts sort of are exchanged almost become unconditional.
So if you liken it to a property purchase, exchange and completion.
Exactly, yeah. So it's pretty much generally exchange rather than completion that sets the date that the disposal takes place. But actually the tax rate's fixed by when it completes. So it's a slightly random. So if you exchanged on the 30th of March, and completed on the 15th of April. Yeah, I think I've probably explained that slightly badly. So exchange sets the date of disposal, that sets the rate, but when you actually pay the tax, is what I meant to say, is by reference to completion.
In that instance, the tax rate would be set at the 30th of March date.
Correct.
So it wouldn't have changed for the as per 6th of April. However, the tax year in which you'd pay it would be the year.
Correct.
That gives you a longer period of time to pay that.
Correct.
Tax, a much longer period of time.
Yeah, and I mean that's a reasonable thing to do, because obviously you don't get the money till you complete. So, but also I think, and just before people get too excited about it, HMRC will absolutely. Well, there are rules in place that basically say, well, if you're trying to concoct something where you're saying, well, we've exchanged here, so the contract is unconditional, but it only completes
if you push it on.
If you try and play silly games with it, then there was they've introduced what they call anti-forestalling rules, which effectively look at people artificially kind of trying to create a tax point before the rate changes, but actually only end up having to pay after the rate changes. So if it's a genuine commercial transaction and for whatever reason it can't complete, or for a couple of months, but then if it can't complete, is it actually conditional anyway? So, but fundamentally, 6th of April is kind of or 5th of April is your target date. If you can exchange and complete, simplifies everything massively, and you get the 10%, the 10% rate.
Okay, and then for the question of if you've got a longer earn-out period, I mean, my understanding is that it's kind of tough. You pay the tax based on the money that you're going to get.
Correct. Yeah.
And then I suppose if you don't get all the money that you've been promised in the earn-out, you have to claim some back further down the line, or?
Yeah, I mean, and I think that's a good summary, but I think, and this is, I mean, we could go down a massive rabbit hole here, but effectively, there's a distinction between what we call deferred consideration and what we call an earn-out. So deferred consideration is a fixed amount, you're just not going to receive it for 12 months. You're absolutely right on that one. You effectively treat it as if you'd receive the cash on the day that the sale completes. So you pay the tax based on that, even though it might be 12 months or even 2 years before you actually get the cash. Earn-out's a slightly different thing in the sense that an earn-out, a true earn-out, is kind of predicated on something that hasn't happened yet. So it might be you only get your cash if the business, does X, or in terms of revenue. So there, I won't bore you with the rules, but essentially the way the rules work is you kind of almost have to estimate how much you think you're going to receive, and you pay tax on that as if you'd received it on day one. But then you have to adjust that depending on how much actual cash you receive down the line. And so on the earn-out, the amount that you estimate, you pay tax at the rate that's in force when you make the disposal. If you receive more than what you estimate, then you pay tax at the rate that's in force when you get it, as opposed to when you sold it. So.
And are HMRC mean enough to charge you interest if you pay less?
No, because I think as long as you've made a reasonable attempt.
As long as they sign off.
If you've kind of said, if you know that you're pretty much going to get, £1 million, and you say, I'm going to stick 100,000 in, then you might not get interest. But what you might get is a question from HMRC, sort of, well, how did you actually arrive at this number, and why is there such a big differential between what you estimated So it's not, again, it's something that you've got to make a reasonable attempt at. But as long as you do, then effectively HMRC might challenge you on how much you've included, but they won't say, you should have, you'll pay interest on kind of any tax that you would have paid had you been exactly, you don't have to be exactly right. Nobody obviously can be exactly right, but you've got to have made a reason.
Okay, so it's not like payments in a kind.
No.
Very quickly then, last one on this, because I'm sure we talked about it pre-budget, that you can actually come into some sort of agreement where you will only pay the tax when you get the cash, almost like cash accounting rather than accrual accounting.
Yeah, there's an installment rate that effectively, if you're not going to get all of the cash up front, there is a mechanism that allows you to kind of almost agree an installment plan with HMRC. I think the issue is that what they look at is, well, have you received enough cash to pay the tax by the time the normal due date is there? So I think I've only ever seen one situation where enough has been deferred that actually HMRC were prepared to enter into an arrangement, because they're saying, well, you've had enough cash to pay the tax by the time it's due, so
pay the tax and hold off on the yacht. Yeah. Okay, fair enough.
Yeah.
Right. I'm just going to have a little question here from, yes, there's quite a few people interested in employers' national insurance.
Unsurprisingly.
So I've had a couple of questions about that prior and a couple of questions on the call. So Paul, Derek, various asking questions such as employers' national insurance. Please give an example of what the impact will be for, say, a firm with 50 employees. Now, Derek, we can't, we could do that calculation for you, but you'd need to let us know what salaries the 50 employees were paid, because it would work a little bit like that. I mean, Paul and I did a quick back of a fag packet, sorry, I can't say that anymore. Do they have back of a coaster summary? And essentially, if you employ one person on 70,000, that's your entire employment allowance wiped out. So therefore, the additional employer's national insurance kicks in at its full rate.
Yeah.
But do you want to talk a little bit more about what's changed for employers' national insurance?
Yeah, absolutely. So this was probably one of the better trailed one, and I think there was a concern that they could actually increase it more than they did. But essentially, the previous rate of employers' national insurance contributions was 13.8%. They've increased that rate to 15%, and I think it's important, and I'm sure people appreciate. But unlike employees' contributions, which kind of are at a higher rate up to the higher rate band and then drop, it's 15% on everything over the threshold, which is when you think about it, is a massive cost to employ people. And the other nasty that was thrown in was that they've reduced the threshold at which contributions are payable by the employer. It was 9,100. It's gone down to 5,000.
Yeah. So just to interject there, because we do have quite a lot of sort of single person limited companies as well, and quite often there we would have the advice of pay yourself the 9,100 potentially, because then you don't pay any national insurance, employers' national insurance contributions, but you get the others, and you get the stamp towards your pension or your state pension credit.
Yeah.
So now that the lower earnings level has not decreased in line with the employer national insurance threshold, that means that if you were to do that, you wouldn't get the credit towards your state pension.
Correct. Yeah.
So, but we have done, Catherine's done those calculations for us, and we still reckon from a tax point of view, if you're looking at company and individual, it's more of an admin burden. Yes, you're going to pay more tax, but it's actually still more cost effective to actually pay yourself right up to that personal allowance of 12,570 and just suck it up that you're going to have to pay some employers' national insurance, and it'll kick in at about, I think, month 7 or 8 rather than just month 11 or 12. So it's administrative.
It's as much for those businesses. It's as much the micro businesses. It's as much an administrative hassle as it is a real cost. But I think it doesn't apply. This doesn't apply to the sort of sole director companies. But the other thing they've done is to kind of increase what's called the employer's allowance, or the employment allowance rather. So which is effectively a discount off your national insurance bill. So historically, you would get the first 5,000 of your national insurance knocked off, for want of a better expression. They've now increased that to 10,500. So there is a bit of a discount. And the idea was that that supposedly takes smaller employers out of the increase. And actually, if your NI bill was previously between 5,000 and 10,500, you actually get a little bit of a win as a consequence of this, because even though the rates have gone up, you're still getting that discount. But that is very much at the micro business.
Absolutely. And it really only impacts people probably with salaries of less than 150,000, really.
It softens the blow to a limited and very limited extent for larger employers, but the smaller employers do get the very small employers do get some benefit out of it. I mean, to the question about 50 employees, I did it again, back of a whatever it is we're allowed to call it these days, calc. For somebody, let's say they had 15 employees who they paid randomly, they paid them all 30 grand a year. The interaction of all of these means that their employer's NI bill would go up by about 7.5 grand a year.
So that's a lot for 15.
If you're employing 15 people, then that's a big old cost, and that's on top of something we'll touch on, I'm sure, is the national minimum wage increase as well. If you got 40 employees, so 15 employees at 40 grand a year, then that's closer to 10 grand that your increase is. You can see that fairly quickly it starts to mount up. The more employees or the better paid your employees are. So I think it is a real impact on the cost of employment, and we've talked about it a lot, but it has to impact on that investment decision. Do I bring somebody new in? Do I give that person extra hours?
So the national living wage then. So again, I think we did a very, very quick calc on that and reckoned that, so if you're bringing somebody in, maybe a uni graduate who's 21, no experience at all, the cost to the employer of bringing that person in due to employer national insurance contributions and pension contributions is going to be a minimum of about £28,000. So there's a knock-on impact there, that if you're paying somebody with no experience £28,000 or 25,000 plus cost to you, then you need to think about your more experienced people as well, who traditionally might have been on 35, 40,000. They're going to need a bigger differential. So your whole pay scale and salary scale needs to be revisited.
Yeah, I mean, I think that's absolutely right. In the interests of recognizing the experience and the value that experience brings to the business, you're going to have to relook at all of your sort of salary structure. Because otherwise, you are going to get. Well, I've been in this job for 5 years, and let's be honest, people, it's very much a what's in it for me kind of situation, isn't it? Why is Jane or Fred coming in from university, and actually because of the national minimum, the living wage, they're only on a couple of grand a year less than me now. Whereas I've been at this for 5 years, and they don't really know very much.
And I really truly believe in paying people properly.
I totally agree.
That wages need to go up in line with inflation. But as a small business owner, it's really difficult to put our prices up in line with inflation, put our prices up in line with wage increases and so on. And there are certain sectors that are going to be hit really, really badly by this. I mean, those that pay people a little bit more, so the small businesses and professional services are going to be hit quite badly by that. But let's look at retail, leisure and hospitality. They're really going to be up against it.
Yeah, and I think you're right. I think it's a real, it's a catch-22 situation, isn't it? Because you really want people to be paid fairly and paid a living wage for the work that they do. But when your margins are wafer thin, and in a period where we've got cost of living pressures even still, and I know the inflation rate is coming down, but the reality is that prices aren't going down; they're just going up less quickly. So you've already got those baked in additional sort of costs for individuals. So discretionary spend like retail, hospitality, leisure, inevitably that's the first thing that gets squeezed. So you've got pressures in all directions for those businesses. Not to mention, and again, I don't want to say that I'm at all against the extension of some rights for sort of workers, because I think again we need to make sure that employees are treated fairly and properly by their employees. But I think the government underestimates the pressure that that does create, because it's almost like they get, small employers, particularly in those low margin, high kind of people cost businesses, really are getting hit from pretty much every angle at the moment.
It becomes, you almost need to employ somebody to manage all of the compliance and the rules and regulations, which becomes tricky in itself.
Yeah, and so I think I wish I knew what the answer was. I mean, there's been a lot of chat about, should the government introduce a reduced VAT rate, for example, for retail, hospitality, and leisure businesses.
They did it during COVID, and it did help.
It absolutely did, and I think it's one of those situations where there needs to be, unfortunately, and this was frankly a fault of the last government, and this government have also carried on. They look at it in a very piecemeal way. There doesn't see, we've got an industrial strategy which is coming through. We've got a corporation tax roadmap. So there does seem to be an element of, let's think about planning for the future. But I don't know whether they necessarily want, all arms of government that kind of are introducing all of these costs and legislation for smaller businesses actually sit round a table and say, well, okay, what's the overall impact for this, and what do we need to do to support these businesses in a meaningful way to make sure that they aren't, having to spend all of their time filling forms in, as opposed to actually, doing what they want to do, which is sell.
And what's the potential impact on job creation? Will those jobs be available for uni graduates, or will employers start looking for either taking school leavers or only taking very experienced people, or in professional services looking at areas outside of the UK for their employment?
Yeah, I think, the whole employment market, I've got a strong view that, the gig economy, as people like to call it, is going to become more and more. I think, that whole thing about, is somebody really an employee or are they self-employed?
So then the IR35 piece becomes, so yes, people will use more consultants potentially because the costs are lower.
Yeah.
And I think one of the other things we should just mention in passing at least is that the plan is to bring the national living wage for 21 euros down to 18 euros. So trying to narrow that gap so that everybody has the same minimum wage.
And again, it's hard, objectively, it's hard not to support that, but I think there needs to be some thought as to what the impact is of that is on the employers, as opposed to as well as the individual.
So I'm going to change the narrative here a little bit. If we haven't answered your questions on employers' national insurance, national living wage, or employment allowance, please pop another question in the chat. Helen's sending these up to me as we go through. Another was tax on jobs, as they might like to put it, or on small employers, is the corporation tax, which the main rate which was set at 25% a couple of years ago, or however long ago, well, last year. So, and while what we like to remind clients is, look, that's not a 6% increase, it's 6 percentage points, which is actually a 30% increase in your corporation tax bill.
Absolutely.
Now, I think the government were very, very clever with their wording, a little bit like the cap on bus fares, which really annoyed me. But I think with corporation tax, they were really clever with their wording, and they've said that they're not going to make any changes, or it wasn't that they're not going to make any changes, but that the 25% is not going to increase.
Correct.
What do you read into that? Because I think you read the same as me into that.
Yeah, well, you don't get to do tax for as long as I am without being a bit of a cynic.
Yeah.
But I think, obviously at the moment you've got a 19% corporation tax rate for businesses up to 50 grand, and then a sliding scale where they make profits up to 250,000. I think the language was carefully chosen to say that the top rate of corporation tax won't increase beyond 25%, but they didn't say, and the lower rate of corporation tax won't increase beyond 19%. So
there could be a levelling up.
I don't think it's a massive leap of the imagination to think that by the end of the Parliament we might just have a 25% corporation tax rate for everybody. Now, that's just pure speculation, but I think the language was chosen very carefully to allow themselves at least the wriggle room to be able to do that if they chose to.
A little bit like the working people.
Yes, yeah, quite.
At least said on that, the better, perhaps. Right, we've got another couple of questions that have come in, and they're jumping back actually to areas that we've addressed.
Sure.
So Linda's asking about about whether you've got a buy-to-let portfolio that have mortgages and are held in a limited company, and how would that be treated from an IHT point of view?
So from an IHT point of view, that it wouldn't qualify for business relief is the first thing to say. So there's a specific exclusion from business relief for businesses which effectively, invest in property. So that would be so the value of the company would be fully subject to inheritance tax. But I think that's the important thing to say there. You value the shares in that instance, which would obviously be net of the debt. So if you've got a buy-to-let portfolio that's quite heavily leveraged, let's say it's worth £2 million, but it's got £1.5 million worth of debt against it, from an IHT perspective, the value of those shares would only be the £500,000. So you do effectively, as in any situation from an IHT perspective, the value of the estate is the net value. So you look at debt that specifically attaches to assets and kind of only tax the equity, for want of a better.
Perfect. Hopefully that answers your question, Linda. And there are, I'm sure, other clever things that if we could maybe look at in a separate conversation, but like whether that's gifting of some of the shares and holdover relief, so there's no tax implications, or top slicing, or different things like that.
Yeah, I think there is, but there are planning opportunities which haven't been affected by the budget, which certainly I think if you get into the point where you've got quite a significant value either in trading businesses or investment businesses, I think it's actually become more compelling now to really think about and plan ahead and get those structures in early doors, because the government's shown that it's got an appetite to make changes around inheritance tax. I know, again, Rachel Reeve's very careful with her words, I think, over the last day or so. There won't be any more tax increases in April. Okay, well, that's great, but what happens in the next October budget? So I think there are planning opportunities, but a lot of them rely on plan early rather than wait till you're 77 and come and say, I'd like to do some inheritance tax planning, because the reality is that the options become very limited in that situation.
Thank you. Another question here from Chris, who, Chris, you're not going to like the answer to this one. So Chris is asking, what happens with IHT if you have 2 or more separate companies? Is the business relief of £1 million per company?
I don't seem to be the bearer of any good news for anybody at the moment, but no, Chris, unfortunately, it's £1 million flat. So you would kind of look at all your business relief assets and you'd effectively notionally have to allocate that £1 million between multiple companies, unfortunately. So no, it isn't. You can't. And similarly, I touched on trust before. Or if you set up 5 trusts post budget debt between them,
maybe not the way you wanted. I believe we've gone a little bit fuzzy. I'm not sure we can do anything about that. But I'm going to ask Paul another question about that. So I'm going to ask how does the budget impact on EOT? We're seeing a huge resurgence, or surge, not resurgence, but a huge surge in business owners selling to what is called an employee ownership trust. And they're doing that because there is zero capital gains to pay in that instance. You want to talk about that? I'm just going to see if I can fix the camera.
No worries at all. So yeah, employee ownership trusts, it's effectively, as Sarah said, if you sell the majority of the shares in your business to a specific type of trust for the benefit of all employees, then there's a 0% capital gains tax rate on that, which obviously, now that the main rate's gone up to 24%, starts to look even more attractive. I think the first thing I would say is don't just do it because you get a capital gains tax benefit from it. I think that's really, really important to say. But there wasn't any real changes to the overall treatment of employee ownership trusts in the budget, but there were some detail changes. And to be honest, the detail changes were really aligning the law to a great extent with the first thing. Easy to be very cynical again, but a lot of people would sell their business to the employee ownership trust, and lo and behold, the people who sold it would also be the only trustees of the trust that own the business.
Oh, wow.
So, they were kind of...
That's the next PPI claim.
Well, yeah, I mean, it was I think, again, typical. If there's a tax concession, people will start to abuse it. I think what the change is effectively now you're going to have a majority of independent, so you're going to have.
I actually thought that was the case because it's just so obviously that moral and ethical case.
It seems so, but the law didn't actually provide that. So effectively, from thing that goes is put in place from the 30th of October. Beg your pardon. You're going to have, effectively, you can either have none of the former shareholders, or if you're going to have one of the former shareholders, you're going to have two non-shareholder.
Okay, so it's not. It's in the go.
Yes.
51% still has to go.
Correct. 51% controlling interest still has to go. And again, my view is best practice. If you're just doing it with 51%, you're probably not doing it necessarily for the right reason.
Unless it's one shareholder selling.
Yeah, exactly. I think that in the circumstances, but I think they're very clear. They want that trust to be genuinely independent. Best practice would generally say those two other trustees might be a trustee. That's not a requirement, but you can't just have a majority of the trustees being former shareholders. So that's quite an important change. A lot of people would set, because this, again, it kind of is really counter to what the rules are trying to achieve. So again, it's mandated now that the trust has to be a UK resident trust, which effectively means that all of the trustees have to be UK resident. So I think that's, again, I think personally a really sensible change.
Yeah.
Another change, the trustees are now going to be responsible for making sure that the valuation on the sale is independent. Because again, unsurprisingly, perhaps, some people were tempted to beef up the value of the business that they were selling in order to get tax rates. So now there's going to be, the trustees have effectively an obligation to make their best efforts to ensure that the price that the trust pays is a market value for the shares. Again, a very, very sensible change. So you can see a lot of this is detailed changes, and most of it really is as much around the administration of the trust and making sure that it's in the spirit as well as the sort of letter of the legislation as was. And the one thing which is potentially a reasonably impactful change for the sellers is if the trust has to meet certain criteria in order to qualify to be an employee ownership trust, including, you mentioned the controlling interest. It's got to have a controlling interest, so more than 50% of the shares have got to go into the trust. If the trust drops below that, it ceases to qualify as an employee ownership trust. So what happens then is that somebody has to pay the tax on. So and the rule used to be, if that happened in kind of the next tax year after the sale, business owner would pay the tax that they would have paid on the sale originally. So they kind of get that 0% tax rate clawed back. If it happened after that, the trust had to pay the tax. It was treated as if it had sold the shares in the business.
Right.
Now what they've said is actually we're going to extend that period that the business owner's on the hook for. So instead of being just if it's by the end of the next tax year, it's actually if it happens in the 4 tax years following that the trust ceases to qualify, then the taxman goes back and says, well, actually, you might have thought you had a 0% tax rate. Actually, we're now going to tax you at the normal capital gains tax rates on the sale.
That's really interesting. So previously, you might have had an instance, I'm guessing here, but this is where my logic's working. You might have had an instance where potentially the employee or the business owner might have sold to an employee ownership trust, and then the maybe 3 or 4 key people within that trust actually wanted to take ownership for the business and drive it forward.
That's right.
And without these rules, if that had been done 2 or 3 years later, because some people do see an employee ownership trust as an opportunity to ready the next generation while still partially exiting and giving them that responsibility with the view to then they will then effectively a management buyout. So in that instance, the tax that paid by the people doing the MBO.
That's right. Yeah. Well, no, not by the MBO, by the trust.
So the trust would need to find its owner.
Correct. Yeah.
For that sale, and now they'd have to find the cash to pay the business owner's tax on that sale.
Well, effectively, exactly that. So to give a simple example, if the business owner sold the business for £5 million, they pay 0% tax. Let's say they set the business up with £100 share capital. The trust then sells the business in 10 years' time for 10 million. The trust has to pay tax on the full 10 million in that situation rather than the 5 million, because it's not an exemption. It's almost a deferral. But what these rules are saying is, if you say it drops below the controlling interest, there's some rules about how many people what percentage of people that used to be shareholders can be sort of employees or whatever. So you can't kind of have a family who sells to an employee ownership trust and the only employees are the family, for example. But it means that the selling shareholders are more at risk of those changes impacting on their position now than they were previously. Most of it, to be honest, is controllable. Yeah. So in a sense, as long as, but it just means, and all the OTs have to do a degree of ongoing monitoring to make sure that they don't. The other one, which can
sounds like a fairly fair. I think it keeps it more honest and it keeps some of the. Most people obviously do this sort of sale for the right reasons, but there are always a few who don't, and it might just make them think a little harder.
Yeah, I think that's absolutely right. I don't necessarily have an issue with any of the changes really, because I think it aligns, the law with what was originally intended. But I think it's just, it's not just a kind of a fire and forget thing. You don't just sell it to the EOT and then that's not my problem anymore. You really, and that's why business owners will want to continue to stay involved in some way, whether it's in the management of the company or potentially as a trustee, just to make sure that people are alert to the fact that actually it isn't just you're not just in an EOT and then it's okay forever. That there are some obligations that you've got to continue to meet right the way throughout.
Makes a lot of sense. So every EOT needs a good trustee to
absolutely 100%. Yeah, say that definitely.
Brilliant. Another couple of questions. One about AIM shares.
Oh yeah,
so they were mentioned. Go on. Do AIM shares get that £1 million BPO?
No,
because they're investments in business.
Yeah. So this was a specific exclusion, and I mean, in a sense, you could say that the fact that AIM shares currently get 100% business relief is a little bit of an anachronism. But the idea was a lot like some of the venture capital schemes. AIM shares, companies that are listed on AIM are smaller. They tend to, potentially, struggle to get investment, struggle to raise capital because of the sort of. So the idea of giving the 100% business relief was to kind of encourage people to invest in AIM and support these kind of mid-cap companies, I suppose you'd call them. Essentially, again, from April 2026, the AIM shares will only qualify for 50% business relief, but it's very clear that £1 million allowance doesn't apply to them. Right. So they are.
So that £1 million allowance is only for something you built yourself.
Correct. Yeah.
Right.
Exactly.
Essentially.
Yeah.
But your shares.
It's all in the technical wording, but effectively, business relief applies to AIM to sort of unlisted investments. AIM shares were originally treated as unlisted investments, even though they're listed. Sounds a bit odd.
Yeah. Okay.
But effectively, they've kind of differentiated.
Alternative market.
So they've differentiated between AIM shares, which are just 50% relief with no access to the £1 million, and as you say, a business which you might only have a 10% interest in it, but it's still not a listed business in any way, and so you can still get that £1 million plus the lower rate afterwards.
Quick one that I'd missed from the start. I think it was a really, really good one from Paul, that asking about if somebody is, say you've got somebody that earns £40,000 a year.
Yes.
And they make a capital disposal that is worth £20,000. So that brings them into the higher rate through that. What rate of capital gains tax do they pay?
So if we simplify it and just let's say the higher rate kicked in at 50, because I can't do the math otherwise.
No.
So in that situation, effectively, you've got £10,000 of your basic rate band left. So the first 10 grand would now be taxed at 18%.
Okay.
And then the excess over what's left of your basic rate band would be taxed at 24%. So it's still
That's really helpful because I wasn't sure whether it would be. It'll just be at the highest rate.
No, you still get access to that. What's left of the basic rate, left of the basic rate band. So.
Yeah. Coming to the last couple of questions, I think touched on that. There was one about non-doms. Yes. So somebody left the UK 10 years ago, for example. What's the impact for them?
There's been obviously a lot of chat about non-doms, and the changes are really aimed at people who come to the UK and claim to be non-domiciled because there's certain tax advantages that are available to them. But obviously, the new system, which is going to be introduced from April next year, also applies to people who did live in the UK, are UK citizens, and have left the UK as well. And actually, potentially, it creates a beneficial outcome for those people.
Okay.
I think just to give a bit of context without going into too much detail, the old inheritance tax system, the current one till next year, relies on a concept of domicile. So domicile is something other than just where you live. It's almost where you belong. The thing I always kind of ask clients is, when you die, where do you expect to be buried? If if you live in Oz but you expect to be buried in the UK, the chances are you're still attached to the UK and you're domiciled in the UK. It's a little, obviously, far more complicated than that. But it's also
where your kids and your grandkids and
exactly.
School and,
There's so many factors, but it's quite a nebulous.
How much time you spend.
No. It's quite a nebulous concept, domicile, and even to the extent that I think strictly under the law, your domicile is driven by where your father was born.
Interesting. I mean, Northern Ireland's home to me.
Yeah.
So I've been here for 25 years.
And I think, that says to me that, although it's all part of the UK in a different situation, where it is almost like, where do you think of as home?
Yeah. Well, my kids are here. So once my mum and dad are no longer there, then
exactly.
So it can change.
So you can imagine it's very as far as HMRC are concerned, it was very difficult to lose what they call domicile of origin, what you're born with. So essentially, you could go and live in Oz for 20 years, but HMRC might still say, well, actually, you're domiciled in the UK. And what that means is that you would still be subject to UK inheritance tax on all of your assets, wherever they are in the world, even if you sort of lived resident in Australia for 20 years.
But therefore, then that to me makes the case that, if they were treating that in one way, then why should somebody who has, come over here for 10 years, but build their wealth or sees themselves as domiciled elsewhere?
Exactly. And so we had this sort of artificial rule of the 15-year rule. If you were here for effectively 15 years, then you kind of almost became deemed to be domiciled in the UK. But again, you can imagine that the whole thing was very nebulous. It was very subjective and led to a huge amount of argument. So the benefit of the change that we're getting is that we're moving to a residence-based test as opposed to a domicile test, and it's going to be very much a hard and fast number of years type rule. So if we look at somebody coming to the UK, it's going to look at how long they've actually been resident here, and that's going to determine whether they fall into the UK IHT net or not. I should say that even if you're not currently domiciled in the UK, then you would still be subject to UK inheritance tax on any UK assets that you have. The difference is that if you are domiciled in the UK at the moment, you're subject to inheritance tax on your worldwide. To take our example, just so effectively, we're going to look at number of years in the UK and also number of years out of the UK, and it's very much going to be a bright line test. And in the UK, we've got this thing called the statutory residence test, which is quite a prescriptive way of determining whether you are going to be tax resident or not. So the beauty of this is actually, at least you're going to have some certainty one way or another. And for our person who might have disappeared off to live overseas in 2014, the way it's going to work is they're going to look at how long you've been how long you lived in the UK and how long you've been out in the UK. So if you've been in the UK since birth, you left in 2014, based on the new rules, you won't actually be, you'll be treated as if you're only subject to UK IHT on your UK assets because you've been out for longer than 10 years.
Okay.
So effectively, that person who might have really struggled to argue that I'm no longer domiciled in the UK.
So, for example, if they're living in Spain with a property there, that property would fall outside of UK inheritance tax.
Yeah, 100%. So the benefit of it is that we've now got a test that is very clear and understandable and is easy to navigate, as opposed to that subjective "where are you domiciled" test. And it does mean that it's much easier for people who genuinely move abroad forever. They're not getting potentially dragged back into the UK IST net, even though in practice they haven't really got any attachment back to the mother country at all.
I'll not ask about when people go a couple of years before. So we'll park that. We'll park that. Let me just see if there's anything else. 1 second. I think the screen's still dropping out occasionally, but there was a last one about making tax digital.
Oh yeah.
Are you familiar with making tax digital for income tax self-assessment?
So this is essentially.
There were a couple of changes.
There have been a couple.
But there've been changes every single year since they first started talking about it.
So if anybody's watching the recording of this, there's a fighting chance that the rules might have changed again by the time, because we've had so much flip-flop. Yeah, exactly. Yeah, but because we've flip-flopped. But essentially, making tax digital is going to be, the people within scope are going to have to keep electronic records of their income and expenditure, and effectively file almost quarterly, not tax returns, but quarterly returns
of income and expenditure.
Yeah, and the flip-flopping has been that we had a date for it, that was pushed back, then it was pushed back, and I think it's been pushed back at least 3 times.
And it was the amounts as well, because it started off it's going to be anybody with income more than £10,000, and that could be across property and sole trade business or partnership business. And then it went to 50,000, and now.
So now it's still at 50,000 initially. So when it kicks in from April 2026, then it's going to be anybody with income. And when we say income, we mean gross income here. So we don't mean profit. So it means income. And as you say, Sarah, it's anything basically that isn't kind of taxed under pay as you earn. Really, it's kind of a rule of thumb. So property income and other investment income are probably and trading income.
So what about interest and things like that? Somebody
I don't think interest. I think interest is fine.
Investment income for dividends.
I don't believe dividends. No, actually, I think when I meant investment income, was thinking about property income rather. But again, who knows? By the time we get there. So 50 grand. If you've got 50 grand gross income across those heads from April 2026, you're in scope. Then that drops down to 30 from April 2027, and then the statement in the budget was that it's going to drop down again to anybody who's got 20 grand of gross income across those heads by the end of the Parliament.
So really, if you've got two
to buy-to-let
properties, or if you've got buy-to-let property and a couple of hobby businesses on the side,
the chances are you're going to be in scope. But we don't know when. And look, I mean, the reality is HMRC just aren't geared up to deal with the software as much as anything, really. So,
but will these also be separate? So if you've got a sole trader who has has a substantial business, is VAT registered, or a partnership that's VAT registered, so they're doing the quarterly VAT returns, and if their VAT returns aren't aligned to the fiscal year end, then you could have returns for MTD that have to be done separately to the VAT returns. Or potentially property returns that have to be done separately. So you could end up having to do a different return every month.
Yeah, I mean, I think the property return.
So we need to think about.
I think it's and there's a lot to be said. A bit like for self-employed people, the government are trying to align their basic period. Yeah, exactly. They're trying to sort of align things so as when MTD does kick in,
should only be one.
You'd only hope that exactly, that effectively everything should fall into line, and there'll only be one. Now in practice, whether that actually works or not, I don't know. But
people do need to consider their VAT quarters and make sure that those are aligned.
It's got to make sense, really, because otherwise you are going to have to sort of constantly be filing different returns. And you'd like to think there would be something that pulls everything together, but
that'd be nice.
Excuse my skepticism again.
AI. Let's see. I think that's it. I think we've covered pretty much.
I think there was one about salary sacrifice that
you're absolutely right. I didn't add that to the bottom of I've got that on a different list. So salary, yes, that's the one I was going to ask you when we were talking about employers' national insurance, because Well, I'll let you explain, because you'll explain better than I can. Salary sacrifice.
So salary sacrifice is this concept whereby the employee says to their employer, tell you what, instead of paying me my salary this month, give me a benefit of some description that, you know, potentially as a more favorable tax treatment.
So the easiest ones to think about are pensions.
Yeah.
You know, a lot of people do salary sacrifice pension contributions, which makes a lot of sense. Electric cars. So electric cars and gym memberships and things like that, they all pay 11-day bills. So the employer will still end up paying employer's national insurance.
That's right, yes, but the employee doesn't pay national insurance on them. And the value of that, benefit, like the electric car, the value of the benefit is a lot less than the actual price that the employer is paying. So there is still an employer and employee national insurance benefit. Pensions is the classic one, and that's the one that most people will
but I think what's going to get you, I think the rules are that the employee has to contribute 5% and the employer 3%, or it can be made up to a minimum of 8% in whatever way, as long as the employer contributes a minimum of 3%.
Yes, that's right.
So at the minute we do 4% and 4% for our employees, and we also give the employees the national insurance contributions that we save, so they get an extra benefit from that. I think there are a lot of companies that do that. And I think a lot of companies will suddenly think, gosh, that's 15%, and we've got a huge bill over here. So that's quite difficult. So do you think that's going to impact?
I think we may well see that there will be a lot more companies that move to that full employer contribution sort of model. And, you know, if you take a step back and look at the employee's position, then they're making their 5% at the moment out of their sort of post-tax pay. And yes, you get tax relief in the pension fund for the 5%, and you know, your employees' national insurance on those. So I think this rise in the up to 15%, we'll see more and more people looking at salary sacrifice for pensions, particularly as being a really good option. As you say, then they've got the option to share some or all of that benefit that they get in terms of those savings with their employees. Yeah, absolutely. I think that's, you know, potentially a real avenue that people will be, you know, particularly those with massive wage bills, you know, saving of 1.2% on, you know, salary sacrifice across 1,000 or 2,000 employees actually starts to be a really big number. So I think, you know, absolutely this could drive more activity in that space.
And potentially on cars and things like that, finding a different way to have a package for your employees that isn't just about pure salary, and therefore has a slightly lower cost.
Yeah, I think that's right. So it's going to cause people to try and be a little bit more imaginative. But when people start to be a bit more imaginative, then there's always a massive health warning that attaches to these things. So I think the first thing to say about salary sacrifice is it does only really benefit a limited range of benefits. In the old days, you could salary sacrifice for pretty much everything. You know, a company car, for example, on the basis that the taxable benefit on the car was less than the salary, and so you pay less tax. The government closed a lot of that down, so it is only a specific range. So you don't get carried away and think you can salary sacrifice for everything, because there are things where basically the rules say, you know, in kind, we're still going to tax you as if you'd received the same amount of salary anyway, so it just simply doesn't work. But also I think salary sacrifice is not easy. I think it's really
sounds easy.
Yeah, it sounds super easy, and you know, in a sense, conceptually, you know, once you get your head around it, it is quite easy. But it's getting it right is so important. It's got to be what the revenue would term an effective salary sacrifice. So what that means is you can't salary sacrifice something you've already earned. So you can't look back and say, I've earned my bonus for this year, I'm going to salary sacrifice it, because revenue would say, well, tough that, you've already earned it, so you can't sacrifice it. It's got to be a variation to the employee's contract of employment. So
where would that impact if an employee decided they wanted to put this year's bonus into their pension?
I think effectively, you know, in that situation, they would potentially be taxed on that. It couldn't go in as an employer's contribution, because effectively they're not, you know, they depends on the contractual terms,
and
right?
Historic.
If it's a discretionary bonus, which the employer, you know, says, well, actually, you know, then there's an argument to say they haven't earned it. But if their contract says, you know, you're going to earn X% of commission or bonus for every car that you sell, then they've already earned that money. So I think in that situation, HMRC will come along and say, well, actually, you know, you're effectively, it's almost an employee's contribution because you've earned that money, so you need to pay tax on it. So I think it's got to be prospective. It's got to be forward looking, and also HMRC don't people flip flopping in and out of salary sacrifice as well. So it's got to be some element of longevity. So just getting the documentation right, because what you don't want to do is tip the money into the pension scheme and HMRC come along and say, well, sorry, but just simply didn't work. So we want the pay as you earn and national insurance. Thank you very much.
No, that would be
a really bad outcome. So if you're going to do it right, get proper tax and legal advice to make sure that it actually satisfies. And you can imagine, just as more people are thinking, oh, salary sacrifice looks quite attractive, HMRC are going to be thinking, oh, we expect a lot more people to be doing salary sacrifice.
Go and look at it and do something.
And a decent proportion of them are going to stuff it up, and therefore this is easy money for us as well. And
for those other elements that are P11D'able, so pensions aren't, but for electric cars, for example, a gym membership that you can do through salary sacrifice, but is P11D'able. I've got somewhere in the back of my head saying that at some stage soon, all P11D expenditure is going to have to go through salary, and therefore that has to be agreed and set up prior to the start of the tax year. So it's not something that if you're not set up to do that, it's not something you're going to be able to do retrospectively anyway, or partway through the year.
Yeah, I think that's absolutely right. They're going to mandate payrolling of all benefits from
that's the expression. Thank you.
I think it's 26 or 27. Yeah, I think you can do it voluntarily now, but they are going to mandate it. So again, that's going to change the whole kind of concept, because effectively, obviously, now you do your P11D and then HMRC eventually get around to changing your tax code, and you get a nasty shock because you've got to catch up tax liability for 6 months in your code or whatever. The idea is that they're going to, much as HMRC love to do with most things, they're trying to push responsibility to deal with this onto the employers and deal with the tax on those benefits through payroll. I've got to be honest to say the mechanics of how that works are a bit beyond me, but yeah, I think it's going to be a big change for anybody who's providing those kind of benefits.
Sandra can sort that all out.
Yeah, absolutely.
Anything payroll related, we'll give it to Sandra.
I know. I just run quickly in the opposite direction definitely. With that sort of thing.
Definitely. I'm sorry that I think the vision did go a little bit blurry there for a little bit, and maybe we were dropping out a bit. But hopefully you got the gist of that. Hopefully we've answered all of your questions. If there is anything else, please do just drop us a line, give us a buzz. I will be posting this on our YouTube channel. And at some point over the next few days, I'll start to snip it down. So we've got specific elements of that we've talked about, and we'll get those done. So I'll share those. If there is anything else, please let us know, and we will happily answer any questions that you do have. I think I've just seen another question pop up on the screen, so I'm wondering whether Helen's going to see that and stick that in the chat. I'll just come over and have a quick look. Excuse me. Oh no, what have I done? That might not have worked. No, I can't see that question. So if we do get it in the chat, that would be great.
Was just a thanks, I think it said. So.
Okay, well, thank you. You're very, very welcome. As I say, any questions, just please fire them over. And I think that's all from us.
Lovely.
So it's goodbye from me.
And it's goodbye from me.
Thanks very much. Bye for now.